Hello, I'm Rachael from Willow Financial Services. Just as a strong tree stands the test of time, effective estate planning ensures that your legacy endures. Today, we're going to explain inheritance tax in the UK, which is a key part of safeguarding your financial legacy for future generations. So let's delve into it. So how inheritance tax works. Inheritance tax is a tax on the estate of someone who has passed away. Everyone has an allowance, which is called the nil rate band. And if they die with assets below this threshold, then there's no inheritance tax to pay. Although this does include any gifts given 7 years prior to death. For anything over the nil rate band, which at time of recording is £325,000, then inheritance tax is payable at 40%. Alongside the nil rate band, there's also something called the residence nil rate band. If residential property is owned at the time of death and that property is passed down to direct descendants, then this gives an allowance of an extra £175,000 per person. What this means is it increases an individual's allowance to £500,000. Now, we should point out the residence nil rate band is lost when an estate is worth more than 2.35 million. Between 2 million and 2.35 million, the allowance is reduced on a tapered basis. If you are married, there is no inheritance tax to pay on assets that pass between spouses or civil partners. Also, crucially, the allowance can also be passed over. So let's consider an example. You have a married couple, person 1 and person 2. Now, if person 1 dies, leaving their whole estate across to person number 2, there's no inheritance tax due. The estate, let's say in this instance, is worth £500,000. When person 2 dies, their estate, including their home, is worth 1.1 million. They leave the whole estate to their children. Person 1's unused allowance passes across to person 2. So that's 2 lots of the nil rate band, £325,000 each, and 2 lots of the residence nil rate band, another £175,000 each. That gives us a total allowance of £1 million. Now, I said earlier, the estate was worth 1.1 million, so that leaves £100,000 subject to inheritance tax. The inheritance tax rate is currently 40%, so that's a bill of £40,000 in this example. So how can you reduce the inheritance tax liability? Really, there's only 2 ways. You either spend it or gift it. Each person has an annual allowance of gifts that they can make, and this is per tax year, not calendar year. So each person can give a single gift of £3,000 each year. You can give as many gifts of £250 as you like in each tax year, for example, Christmas or birthdays, as long as you have not already used an allowance up on that person. For weddings or civil partnerships, you can also make gifts. This could be up to £5,000 for a child, £2,500 for grandchildren or great-grandchildren, and £1,000 to any other person. Finally, you can also make regular payments to help with another person's living costs. Now, there's no limit to how much you can give tax-free, as long as you can afford the payments after meeting your usual living costs, and this comes from your normal monthly income. This is known as gifts out of normal expenditure. Now, it could include paying rent for a child, paying into a savings account for a child under 18, or giving financial support to an elderly relative. You can give larger gifts, but these may still incur inheritance tax. These are known as potentially exempt transfers, or PETs for short. The reason these are only potentially exempt is that you have to live for 7 years after giving the gift for them to be completely discounted. This is why it's called the 7-year rule. If you pass away during that 7-year period, then tax is still payable, but it will be on a sliding scale, slightly reduced. Now remember, it's only if assets at time of death are over the nil rate band that any of these gifts are relevant. Someone whose entire assets are below the threshold can give away whatever they like. Trusts can be a very valuable tool in estate planning. They allow you to set aside assets for beneficiaries, potentially reducing your inheritance tax liability. Different types of trusts have different tax implications, so it's essential that you seek advice to ensure that they align with your estate planning goals. Now, you do need to be aware of the deliberate deprivation rules. This is where someone reduces their assets prior to needing care. This is an entirely separate issue to inheritance tax, so the gifting rules that I've mentioned are irrelevant. Local authorities have the power to go back several years into somebody's finances and assess if they have gifted away assets for the purpose of not having to pay care home fees. So when is inheritance tax not payable? So any gifts made to charity are completely exempt from inheritance tax. If you leave over 10% of your estate to charity, then the rate you are charged inheritance tax at reduces to 36% instead of 40% on the remainder of the estate. Agricultural property is also exempt, provided that it meets certain conditions. Any ownership of a business or share in a business is included in your estate for inheritance tax purposes. However, your executors can apply for business relief, provided the deceased has owned the asset or the business for the 2 years prior to death. There are also some types of investments that will qualify for business relief. The compliance bit. Willow Financial Services is a UK-based FCA-regulated firm. Therefore, the information in this video is aimed at UK residents. Tax treatment varies subject to the individual circumstances and is subject to change. Business relief schemes may invest in assets that are high risk and can be difficult to sell. The value of the investment and the income from it can fall as well as rise, and investors may get back less than they originally invested. To conclude, planning for inheritance tax is like tending to a mature tree in your garden, ensuring it continues to thrive and provide shelter for years to come. Regular reviews, especially after major events, and careful planning can protect the value of your estate and your legacy. You can visit our website to access our financial guides and workbooks, and follow us on social media for more hints, tips and insights. At Willow Financial Services, we're here to guide you through those important decisions, helping you to ensure that your financial tree remains strong and resilient. If you'd like personal advice, please get in touch.